Good morning, everybody. Welcome to the morning meeting of our virtual hedge fund we call the ARMR Investing Way. We're going to talk about our three portfolios, our three disciplines. We day trade the S&P. We call that ARMR Carry trading. We swing trade the indexes. We call that ARMR Macro. And then we have our ARMR Invest portfolios where we own individual stocks. So I'll go over all three of those. We put that together into a portfolio we call ARMR Flagship. So how do I use those three portfolios to manage capital? And I'll walk you through step by step where we are in the cycle. We'll go over top stocks to watch that we may be buying. I'll go over top stocks to buy that we've added recently. And I'll take any questions you might have. So throw them into the comment section of this video. I'm happy to go over it. Before I dive in, grab a pen and piece of paper, get yourself ready. And remember, when I say a virtual hedge fund, I'm asking you to think like a portfolio manager. I'm going to share ideas. I'm going to share information. I'm going to share strategy. But at the end of the day, you got to figure out what works for you. What's your risk tolerance? What's your goal? Execute your own strategy and be the smart money. All right. So step one, before we get into DELL and all that kind of thing, I want to start, as I always do, with this chart right here, this page, 5 charts. These are 5 of the top 10 indexes we follow to make up our risk monitor. So every day when I sit down at my desk, I think of a couple of things. Number one, where is the market cycle? 8 out of 10 stocks follow the market. So we've got to figure out where the market is in the cycle before we ever decide to make a new investment. And number two, how do I get on the right side of probabilities when reward is worth the risk? If I can answer those two questions, am I on the right side of probability? Is the reward from here worth the risk? Then I can commit capital. Those are the two key questions. That's the number one thing I think of every time I come in. Market's open. What am I going to do? Look at a trade or look at an investment. I'm asking myself from here, whether it's a day trade or an investment or a swing trade, is the risk worth it? Do I think the move from here is big enough for the risk to the stop? And am I on the right side of probabilities? So how do we get on the right side of probabilities? 8 out of 10 stocks follow the market. That's a fact. So we use the risk monitor to tell us where we are in the market cycle. When the risk monitor goes green, that's the best time to put capital to work. Not a crystal ball. Green's not crystal ball. It's a probability. 10 indexes, 10 assets, I should say, really, ranging from the S&P weighted index to Bitcoin, small caps, to the 30-year bond. Okay, so we got 10 assets that we follow. We have ARMR algos designed for those 10. The volatility of each is different. When they all do the same thing at the same time, that's the footprint of institutions moving capital. So when we say risk monitor green, all 10 indexes are telling us risk on is occurring. So the window of opportunity to make money from a probability standpoint is at its highest at that moment. And vice versa. When all 10 get stopped out, risk monitor red, things can get very ugly very quickly. So we have to protect capital aggressively. And risk monitor yellow is somewhere in between. Okay? So with that as the backdrop, where are we now in the cycle? The last time we had risk monitor green was a follow-on signal. Let me show you the S&P 500 as a basic guide, okay? I'm going to blow it up a bit, see where we are in the cycle. The original risk monitor green this year, the big risk monitor green this year was on the 24th of April, right near the lows after the tariff tantrum. Risk monitor went green right there. So in the midst of all of the negativity, the risk monitor told us institutions are starting to put money to work aggressively. So it's time for us to put money to work, no matter how uncomfortable it felt. The news cycle made it seem very uncomfortable at that moment. But the best risk monitor greens happen in the midst of a cacophony of bad news and fear. So we execute here. That's a dark green box. Then along the way, we have these light green boxes, which are follow-on entry points, follow-on risk monitor greens. We go green, yellow, back to green. So right now we're in this, I don't know how to describe it other than absolutely perfect 45-degree angle market uptrend since we originally got long the market at the end of April. You've heard me talk about this. This is the strongest bull market on record as judged by how many days the market's gone up without a 6% correction. This is the strongest we've seen it since 1966 and 1957. That's just an interesting fact. It doesn't help us manage money, but it does put it in perspective. I titled today's discussion Party Like It's 1999 because that's what it feels like to me. 1999 was the year of the dot-com explosion. Don't start talking to me yet about dot-com implosion of 2000. Don't talk to me about that yet. We'll get to that in a minute. This is 1999 right now. And when we look into our portfolio, we're going to see a whole bunch of stocks in here. I think I owned them in 1999. The similarities are incredible. I'll get to that in a minute. Let's stay focused on the risk monitor. So the risk monitor went green. The last time we had a follow-on entry, September 12th. So we're almost a month into that. So when it comes to putting capital to work now, the further and further and further away we get from the original risk on green entry, the more and more dangerous the entries become, okay? Because at some point out there, there's going to be a 5 to 6% correction in the S&P. And when the S&P corrects 5, 6%, a lot of stocks in your portfolio are going to correct 15 to 30%, depending on the type of portfolio you built. And that's not going to be pretty. So how aggressive do we want to be at this stage? Not that aggressive. And anything we do add right now, the stop is the low of the day we're buying, and we're out of those positions immediately if the market rolls over and the risk monitor goes yellow. So last in, first out risk management on anything we add now. So you might ask me, why would I add anything right now? I'm asking myself that question. So maybe you're asking that question. On the one hand, the answer really should be, I shouldn't add anything right now. I don't know about what you guys are doing on your desk, but we are absolutely crushing it right now. The last 30 days, the last 60 days, God, one of the best times I can ever remember. And I was having a pretty big run in 1999. I got into business professionally in 1993, 94. Graduated university, got into the business. So I remember 1999. Ooh, we had a huge year, 99, and we had a huge first 3 months of 2000. So now let's talk about that for a minute. If this is October 1999, by the way, the market's powering through what should be the two most difficult months of the year, right? September, remember start of September, all the Chicken Little's out there telling you how dangerous September is. Be careful, don't own the market. We're made a killing in September on this desk. So don't pay any attention to those people, okay? But I will say to you that when markets crush through the norms, like normally September and October are difficult, and the market melts up through it, that's a sign of the strength of what we're involved in now. So do I think the risk monitor is going to go green to red? Not really right now. I think at best it will go green to yellow and then green again. And another way to express that is the strategy of buying the effing dip, right? BTFD. That's the type of market we're in right now. And the way I see that is risk monitor green to yellow. There'll be a correction of 3 to 5%, and then the market will go again. So somewhere out there is going to be a correction. But if this, and that correction, I think I'm giving you a base case scenario. It might play out different. I reserve the right to be more defensive. Market could go risk monitor red. For other events, there could be events that happen that get in the way of the description of 1999 I'm sharing with you, okay? So if that happens, nothing that I'm saying will matter. But assuming all things are equal, I imagine that the 3 to 6% sell-off that will happen at some point here will be a buying opportunity, not a selling opportunity. The way we'll handle that on this desk is we'll go risk monitor yellow, we'll raise a bunch of cash, but we won't go to like max cash. Stops will be getting hit on some positions, we'll raise cash. Positions that have hit targets, we'll book some profits. And then when we get the next ARMR algo buy trigger risk monitor green, max investment again. Okay. So how is this 1999 all over again? You'll hear people say that in a negative way. They'll say that like, look out, that means the market's going to crash, but they're missing, they're going to miss, just like they did in 1999. They're going to miss a 6-month window of, just massive equity gains. Okay. I remember 1999. I remember the early 2000s. Everybody was calling the top. They were calling the top for like 6 months. They missed an unreal move. Then when the market broke down, they said, see, I told you it was a top. You told me that 6 months ago, and you missed massive upside. Okay. So calling the top early in a market like this is going to be a mistake. We don't need to call tops. We have stop loss discipline on this desk. When we get stopped out, we go to cash. That's all. That's not hard. We did it in the year 2000. I was using stops in the year 2000. March of 2000, it was March 27th of 2000. I remember the week of March 27th of 2000 because my entire portfolio got stopped out in like 2 days. At the time, I was just using static stops, like 7% or something. So my whole portfolio dropped 7% in like 2 days. And I went to 100% cash. That was pretty ugly that week. But I was up like 30% for the year. So all right, I was up 30. Okay, got stopped out. And the market dropped 50% in the next 2 months. And I was in cash. This was year 2000. So this isn't a hard thing to do right now. There will be a time out there where we have an ugly week and we go to cash. Until then, we have to get while the getting's good. You don't have windows like this very often in the market. What are the similarities? Well, .com was the internet revolution was happening, right? And so what we have today is the AI revolution. It's the same type of step change. It's just a massive change in the way business is done. What I find very compelling Want to talk about the differences between 1999 and 2025? It's a little scary. If you're a bear, you should be very scared. And as a bull, but as a risk manager, it makes me nervous because I'll tell you the differences between 99 and today. In 99, you did not have a Fed that was adding liquidity to the system and cutting rates aggressively. And that's what the street is expecting in the next 6 months. The Fed just cut rates. And if they continue to cut rates and add liquidity to the system, that is like spraying lighter fluid on a fire of a bull market. And we didn't have that in 1999. So I can't even imagine what the year would have been like in 99 and the first part of 2000 if the Fed was cutting rates. But that's what we've got right now. It's a little crazy. The other thing is, you could argue that the stocks we're buying in our portfolio now, they have real earnings and real revenue from the AI revolution that's going on. In 1999, the dot-com bubble, there were so many companies that were losing tons of money building out the internet. So they were building out the internet. Stocks were going to the moon. They had no earnings. In fact, they were burning through cash. And the revenue might be coming in on some of the companies, but not many. There was a lot of concept stocks. So when the music stopped, these companies didn't really have anything. A lot of them went bankrupt. Fast forward to today. What are the stocks that are driving this market? The build out of AI. And it's driving earnings and revenue for these companies. This is real. These companies aren't burning through cash. They're seeing their cash flow go berserk. Yes, there are some concept stocks out there in AI, and I suspect some of them are going to go bankrupt when this is over. They're spending a lot of money trying to catch up to AI to do something to help their business, and it's not helping. And they're going to go bankrupt. I'm not buying those stocks. Let's take a look at some of the stocks in our portfolio recently that make me feel like I'm in 1999 again. Ready? Here's the number one stock. I kind of like something I really remember from 1999, and I can't believe we do it again. And that's Dell Computer. So in 1999, I mean, Dell Computer was, God, one of the hottest stocks out there. If anybody was around for that period, do you remember there was a group of Dell, a group of investors who owned Dell, and they would meet every month for a barbecue in Texas, and CNBC would run down there and interview these people. And they were just average, everyday Joes who had bought Dell, and Dell stock had gone to the moon, you know, and then they all got buried because they had no risk management rules. But during the boom of 1999, 2000, everybody was talking about Dell. So fast forward to today, it's kind of funny. Here we are, and we bought shares of Dell recently, just last week we bought it. The ARMR Algo buy trigger was right in here, and we got long Dell off of one of my favorite chart patterns. Why are we doing Dell here? Not because of personal computers, although interestingly enough, the AI revolution, Windows 11, I do think is going to drive a major upgrade cycle for PCs. Put that aside, okay? That was driving Dell in 1999, the upgrade cycle for PCs, okay? So I think that's actually going to happen. But the real reason to own Dell now is that we're focused on the guys making real money, earnings and revenue exploding, guiding higher, analysts' expectations going up for real growth because of the data center build out for AI. So think about it this way. It's a gold rush. We're not buying companies that are trying to find gold with the use of AI. We're buying companies that are providing the picks and the axes to all the guys that are digging for gold. That's what we're buying, right? Look at the data center. What companies are benefiting from the build out of data centers? Here are some of the stocks that we own. Dell Computer. Their servers are all over the data center. Well, guess what? Those servers get wicked hot. They run hot and they have to be cooled. We own VRT, Vertiv Holdings. all over the data center, cooling down the data center. All this data needs storage, right? All this data needs massive amounts of storage. We're long Micron down in here in these green boxes, exploding higher. We're long SanDisk from this level right down here. August 27th at $47. The stock's trading, what's it trading now? 129, 130. We recently added, and this is just a couple, actually, this is just yesterday. We just added yesterday shares of Cisco Systems. I feel like it's 1999 all over again. There's a huge base in Cisco Systems. There's the original breakout. That number one is the original breakout of the huge base. Then the consolidation on top of the 50-day moving average. Now the buy trigger. We just added this yesterday. So it's 1999 all over again. It's the build out of the data center. There are many different aspects of this. How about the uranium stocks? They're going again today. I saw an upgrade on CCJ, which is our biggest position in uranium. I see quad U's blowing out, although that may be something to do with rare earths today. But going back to uranium, so it's the need to create power for all these data centers. Hey, here's a simple, low risk proposition for this market. It's the utility stocks, and specifically the utility stocks that benefit from all the demand of energy for data centers. So you can follow this data center story all the way through the portfolio. We own Duke, we own Southern Company, we own Dominion. AEP will probably gonna own again. There's many different ways to play this data center story. It's 1999 all over again, but you have real companies with real earnings, real revenues, and a Fed that's adding liquidity. Manage risk, patience, take advantage of weakness in the market. We're long in the tooth of the last risk monitor green signal. So I'm fighting my urge to go out onto the edges of risk right now. I don't want to add a whole bunch of names that are concept stocks with no earnings, no revenue. Those are going to be really dangerous when the market has a 3 to 6% correction. I don't want that risk. So I'm staying focused on the bigger cap names with real earnings and real revenue. Geez, I even added Microsoft recently. This is the rectangular breakout. This is the pullback to test the 50, just like Cisco. This is the buy trigger. Okay. So those are my thoughts, big picture. You see what we're adding to the portfolio. I'm going to give you a couple of ideas that are top stocks to watch, you could say, right? Because I just shared with you top stocks to buy. We already own them. Here's a couple of stocks that we may be buying. They're at the top of our whiteboard. I call them top shelf. Following this story of AI, hey, you know, there's many ways to skin this AI cat. We're long Cleveland Cliffs. Stock is skyrocketing for us. From 9 and change, now we're trading up around 14. This is steel company. Do your own research on this and find out why the stock is going up so much. It's tied to the data center. It's kind of a fun idea. I'll give you some homework for that. You go do your homework and figure out why. All right. Top stock to watch. We're doing research right now on applied optoelectronics. Chart pattern looks great. ARMR algo buy trigger. We have a Substack. It's free. It's where we post our research reports. Go subscribe. armrinvesting.substack.com. It's free. We're doing research right now on this stock, AAOI. If we like what we see, we'll post that research report for you. Okay. And it may be a stock we add to the portfolio It's tied to the data center AI build out. All right. And another stock, and here's something I like to do, and then I'll get to your questions. If you have any questions, go ahead and throw into the comment section. I want to share with you Doximity for a minute. Doximity, we have traded all the way up from down here last year. Okay. So we've traded it once, sold it in the red arrow, got long again in here. It blew out. We booked a profit right up in here, traded it here, traded it again here. So we continue to trade Doximity and make money. Doximity is an interesting story. It's like, I'm not going to get into it now because it's late and the market's going to open. But this is what I wanted to say. Every time you see me get stopped out of a position that's on our whiteboard, we've done the research, we like the idea, we book a profit on it, we get stopped out. It goes to the top of my whiteboard to watch if it holds in the stop area. If that key location holds, I get stopped out and it doesn't go lower and it builds a base right there. We get another ARMR Algo buy trigger. That's the first stock I want to add back to my portfolio because the market's just proven that stop location is being defended by institutions and they're coming in to buy more. So if that happens in the next couple of days, we get a buy trigger on Doximity, that'll go back in the portfolio. We're going to trade it again. All right. So let me just run to a quick question. I see, Mark, you're asking a question about cannabis stocks, Tilray in particular. Tilray is running this morning, right? What's it up today? I saw it was up this morning. I didn't see why. It's up a little bit. I wouldn't say it's running. It's trading around $2. It's up a little bit. I'm not a big fan of Tilray. I can't speak intelligently on the topic of Tilray. Okay. I can talk to you about what I'm doing in the cannabis stocks. We'll jump on the cannabis couch for a minute. I'm going to give you a thought on why Tilray may be going up, right? Tilray has a lot of exposure to the hemp market. I think that whatever rescheduling is about to happen here in the US, it's going to come with a clamp down on all of the really illegal hemp products that are out there. Probably the illegal marijuana products that are out there too. So I believe that we're going to get a reschedule before the end of the year. I think that reschedule is going to be great for US MSOs. So we're long MSOS. We have a couple of positions in like TrueLeave and things that I like there. Okay. But ultimately, when we get that reschedule, I think it will also come with enforcement actions from the Trump administration to clamp down on all of the other stuff, all of the junk, which is great for US cannabis and probably great for Canadian cannabis that is selling product that is, approved. Do you see what I'm saying? I think there's huge loopholes and a lot of terrible product being sold in gas stations to kids. And so what's going to happen on the one hand is Trump is going to reschedule it. And then to appease the part of his base that doesn't want a reschedule, he's going to come out with an initiative to clean up the streets of all the other junk, which quite frankly is fantastic if you own the real companies selling real products. Okay. So anyway, that's what I think is going on there. I'm not a buyer anymore of cannabis. We already own our cannabis positions from earlier in the year, Mark, in case you're not aware of that. We got long aggressively cannabis down here. I'm looking at MSOS right now. So down in this location right here, under $3. And now we're just, we have our positions on. We've taken out our capital. So we're kind of playing with house money now. And we'll see what they do when we get the reschedule. All right. Ladies and gentlemen, I appreciate you spending time with me. I always love chatting with you. The bell you heard it just ring. I've got to get the live trading desk started for ARMR Insiders. So guys, you'll see it on our Slack trading desk. The link for our live stream will be trading the S&P as always. We'll be looking at doing research as I described. Everybody else, you're on your own the rest of the day. I wish you nothing but success if you're not a subscriber to the ARMR report, if you're not an ARMR investor, quite frankly, I don't know why. Right? We're just making a fortune. You should be in here joining us. There, I said, go subscribe. armrinvesting.com. Go check it out. ARMR Substack, free. Go check it out. Join us. Get the information that makes money and the execution that protects it. Everybody, think for yourself. Figure out your risk tolerance, your goals, your strategy, execute it, and be the smart money.